If you had your money in something that you couldn't touch for decades, and it was stuck in a volatile box that you didn't know what was going to happen inside that box, how would that make you feel? If you're a business owner, how would that make your employees feel? Conversely, what if your employees, each of them, had a bank on yourself type policy as a benefit from you, their employer, in their portfolio? What kind of employees would that create for your business? How might that attract and retain even better employees? So let's talk about going from the 401k to a 162A. So here's a fun fact. The 401k gets its name from that particular part of the IRS tax code. It's section 401, subsection K. Now, some people think that the 401k was handed down by Moses himself off the mountaintop, but no, it's actually fairly young. And there are lots of other sections and subsections in the tax code that allow for numerous financial strategies to be implemented for your employees. Now flip back to another part of the tax code and you're going to find section 162, subsection A. So this is part of the tax code that describes executive bonus life insurance contracts. So I want to spend a few minutes talking about how a typical 162A plan, an executive bonus arrangement, really works. Now in this case, the company pays a bonus to one of its key employees in the form of a premium payment to a whole life policy that the employee is the insured and owner of. Now the company, your company if you're the business owner, deducts the bonus payment under IRC section 162. So you can have a legal reason to deduct any payment you make into the life insurance for your employee under that section 162. The employee then will owe income tax on the bonus amount, as it'll increase their W-2 income when you pay them that bonus, just like any other bonus. Now, the employee can designate his or her beneficiaries, and if they live a long lifetime, the policy cash value can be there as a supplement into their retirement. Now, the policy is often structured so that additional premium payments to the policy are not required after retirement. In other words, you don't want your employee to feel like they're on the hook to pay premiums way into their 80s. No, when they retire, the game plan would be that the premiums would go to $0 and they just have a big pile of money in cash that they could spend in retirement. There's a neat little image of this in our show notes if you'd like to take a look at how it all works. But it's very simple. Let's take a closer look at what some of these might look like and what the benefits are. Let's talk first about your benefits if you're the employer. First of all, the real purpose of using an executive bonus arrangement is to help the business attract the right type of employees and then keep them there at the company so that they can be as helpful to your business as possible. The employer then is able to choose which employees receive the benefit. There are no requirements that you have to pick some certain percentage or group of employees to participate in this. You could literally do it for just one employee and not any of the others, or as many or as few as you wish. Next, since the bonus amount is considered additional compensation, so the business will have an income tax deduction, that's cool, for the compensation paid as long as the compensation is considered reasonable in the tax law. You can look that up or talk to me if you'd like to discuss what reasonable means under the definition of the Internal Revenue Code. Next, executive bonus arrangements are typically very simple to implement. It might be a new idea, but it's actually very simple to administrate, makes them very attractive as fringe benefits for employers or as the base benefit for as many employees as you want to include. I have many companies that I work with where this is the replacement for the 401k. In fact, the only administrative cost needed for the arrangement is for the employer to set up the premium payments at the start and make the premiums once a year. It might take you 15 minutes a year to manage and administer this employee benefit. Next, the additional benefit to the employer is that there are no maximum or minimum contribution requirements. Again, it's not under all the laws that govern 401ks and IRAs, so there's no minimum limit, there's no maximum limit. The employer is able to terminate the arrangement without notifying the IRS. So there's a lot of benefits to the employer. But what about the employee? Executive bonus arrangements can be customized to meet the employee's individual needs and offer additional family protection, I think, at a low cost. Remember, it is life insurance, so we're giving that to the family first. Second, the employee owns the policy, and they have access to cash values and the ability to designate any beneficiary they wish. So it could be a spouse or a family member or charity, whatever. And while they're alive, any cash values that accumulate are accumulating with no taxes due. It's tax-deferred growth, and it can be used to supplement retirement income, and that income can be no income tax when the money comes out in retirement, which creates a supplement to their retirement income. In addition, one more benefit. Remember, you're building up this big liquid bucket of money, and as an employee, you might have a life outside of the work environment where you might need to use this for kids' braces, kids' college, vehicles, medical emergency, you name it. This is a liquid bucket of money you can access before you retire for any reason. Can you think of some ways you might be able to use something like that to help your financial life even before you retire? Now, there are a few drawbacks, things I want you to know about from the employee's perspective. Okay, first of all, from the employee's perspective, the bonus you receive from your employer is going to increase your compensation. Not a bad deal. Got a pay raise, essentially. But that'll also put you, that'll be a taxable increase on your income. That might put you in a higher income tax bracket. Although we're going to talk about the double bonus strategy here in just a few minutes that's available from your employer. Next, the executive bonus arrangement using life insurance to make it work, the employee or your family member must be insurable. So that's something you got to consider as well. You got to have the health to be approved for something like this. Now, if you can't get you or a family member approved, there are some backup options. So again, reach out to me at notyouraverageFinancialPodcast.com and we can discuss that. Third, if the employee terminates the employment early, then you're going to be on the hook to cover the premiums. Although this might be seen as a positive to your employer, as it's basically another way to keep employees from bailing on you before you want to see them go. Now, you didn't start your business to color by number, or just take the path of least resistance, or the oh-so-average path everyone else is on. So why do the same with your employee benefits? As you can see, executive bonus arrangements can be a super attractive benefit to offer your employees to stand out and at the same time offer a very simple and easy to implement strategy for your employee benefits. So as we kind of wrap up this episode, let's take a look at an example of how this executive bonus strategy would work. Both the business and the employee need to see this from their perspective. So, John is the owner of ABC Company, which let's just say is a successful graphic design company. Much of his success could be attributed, you might say, to the go-to sales guy, Bob. Bob's been with John from the beginning, and he is the key contact for most of the big accounts that the company has. So John would like to reward Bob for his performance and also give Bob an additional reason to stay with the company since it would have a big impact on the company if Bob left. John offers Bob an executive bonus arrangement where ABC Company will pay $20,000 in premium per year into a whole life policy designed the bank on yourself way. So ABC Company deducts $20,000 bonus payment under the IRC Section 162. The $20,000 premium payment made to the policy owned by Bob is considered additional compensation. So Bob is in the 28% tax bracket, so he'll have an extra $5,600 income tax due on that bonus that he's going to need to pay. The policy will help Bob supplement his retirement, which is great, and it provides life insurance protection for his family. So let's talk some about this double bonus idea. Now, you may have just heard in that example, John and Bob, the bonus paid to the employee for the insurance premium was taxable as compensation to the employee, to Bob. Now, again, it was deductible to John, so he got a nice juicy tax deduction. But this could be seen as a drawback to Bob, the employee, as he's going to have to come up with some funds or something to pay the income tax liability every year. Now, there is one way for the employer to help the employee pay this extra income tax liability, and it's called the double bonus. If the double bonus approach is used, then the employer, John in this case, will pay an extra bonus amount for part or all of the associated tax liability to Bob. So that just kind of means you're paying the payment that would end up going to the tax man to Bob. So he's got that money to cover the tax bill. Now, this obviously means you're going to be putting more out of pocket from John to Bob, that cost of the executive bonus arrangement to the employer goes up. But the nice thing is that's also deductible to John. And by the way, all of this is completely negotiable with Bob and each employee. Where a 401k, basically everyone has to get the same thing whether you like it or not. With an executive bonus arrangement, each employee could be offered different benefits. Bob could get the double bonus, and another employee might not get the double bonus at all, or even get an executive bonus life insurance at all. They might be stuck with nothing until they show their worth. You could even offer the double bonus as an incentive to stick around. You might give the double bonus after the 5th year of employment, for example, or after they hit a certain sales metric, for example. So let's just take a look at the example of John and Bob again. But in this example, let's say John went ahead and decided to offer that double bonus arrangement to Bob to help with the income tax due on the bonus. So instead of receiving $20,000 per year for the premium on the life insurance policy, Bob's going to receive a bonus of $27,700 per year. And essentially that's the amount of money needed to cover the bonus's tax and the tax on the extra bonus. So Bob would have an income tax due on the bonus in the amount of $7,778, and so that would mean he'd keep a net tax of $20,000, and that $20,000 would go directly into the premium of the life insurance policy, making the out-of-pocket cost for Bob exactly $0. So I hope this Bob and John case study gives you some idea of how this could work. It's literally infinite how you can put this to work for your employees. And now think for your employees, how might they use their cash value today? If your employees have any imagination, they could probably come up with a long list of things they could use their liquid cash for without sacrificing their retirement later on. What about vehicle purchases? How about home repairs? Paying off your debts, covering kids' college expenses, investing in real estate or a business or something like that. I mean, I even know of one business where their employees borrow from their policy to invest in company stock. That's kind of cool. So there's literally no prohibited transaction or limit to how an employee might access the cash value in their policy. And they're in control of repaying the policy loan that they used to access the money on their terms. Meanwhile, this is very important. So come back to me if you've been multitasking. This is very important. The policy does not stop growing even on the capital they borrowed. This means the retirement readiness is not going to be harmed just because an employee needed to buy a new car today. As long as they pay off their policy loan by the time they retire, their cash value will be made whole, and they'll have exactly the same cash value they would have had they never borrowed the money for the car in the first place. Try doing that with a 401k. Now, it's true that you can borrow against a 401k, and we've done a whole deep dive on comparing bake on yourself type policy loans with 401k loans in episode 206 of Not Your Average Financial Podcast. So if you want to hear more details on that, go check that episode out. The skinny is, however, that you hand over with 401k loans, you hand over the control to the 401k administrator. You pay taxes on your money twice when you borrow from your 401k. Why would you choose to do all of that when you have your whole life policy, which is liquid, accessible, and tax-free for any reason? Now, how about your employees? How might they use their cash value later on? Once again, your employees may or may not be able to think this far in advance, but imagine all the ways their 401k alternative, i.e. an executive bonus life insurance policy from Section 162A, might contribute to their financial security later on in retirement. How about retirement income? Many people use their life insurance cash value during their working years as a source of cash and liquid assets needed for major purchases and expenses. As long as the loans are paid off by the time they retire, which is something I teach and coach our clients to do, then they'll have all their cash value earning uninterrupted for the employee when they're ready to spend it again in retirement. How about Social Security offsets? Most pre-retirees, that's anybody working, most of them don't realize this, but up to 85% of your Social Security income can be taxed if you make too much money from other sources in retirement time. That includes your retirement accounts like 401ks and IRAs. However, life insurance does not count against your Social Security provisional income. How about lifestyle protection? When you add a significant chunk of monthly income to your retirement, would that help your lifestyle? Sure, would for me. What if inflation kicks up and you can't keep up with inflation with traditional retirement accounts? Well, life insurance will be there for you in that regard. How about tax-free income? Forget about inflation. What if tax rates double on you? If you give Congress 30 years to make up their mind on something, do you think they might just raise taxes on you during your retirement when you can least afford to keep up with the tax rate changes? And as you look at our nation's future, do you see taxes going down or up? Do you think tax rates could double? Most importantly, do you want to pay those taxes? How about paying off your mortgage? Unfortunately, many retirees these days are entering retirement with the long-term 30-year mortgage still hanging over their heads. If their policy was sufficient enough to pay off the rest of their mortgage balance in retirement, well, boy, that'd be like giving themselves a pay raise right as they enter their golden years. Finally, long-term care expenses covered. Many life insurance companies offer a free option or rider on a policy that allows you to access even the very large death benefit while you're still alive under certain medical conditions and circumstances. If you have a chronic condition, a terminal illness, or other specified medical condition listed in the contract, many insurance companies will give you 75 or even up to 95% of your death benefit while you're still alive. So clients will use this to help cover rehab costs, long-term care costs, memory care, skilled nursing care, home health care, just about anything else you can imagine. One person even used it to go on a worldwide cruise with their entire family. I mean, what a way to be remembered, right? So just by thinking a little bit outside the box, look at what you've been able to do in just these last 30 minutes or so. Just turning a few pages in the tax code to get over to 162A, look at all you were able to accomplish. By thinking creatively and setting up executive bonus life insurance contracts, you can establish a better than a 401k alternative that'll provide great functionality and peace of mind for your employees and for yourself for years to come.